next section is financial reporting developments. So thank you, Grant Thornton. I have borrowed this little screen from them. I'm only going to speak to the first three areas because they will impact you now and they will impact you and your clients in the next 12 months. So something to really pay attention to these next few slides. Okay, AASB 2019-4. This affects 30 June 2020 clients. So we're talking about now. And it affects special purpose financials. So that's going to be a lot of your clients. There are new disclosure requirements that they have to comply with if they are a not-for-profit, private sector entity, and if they lodge special purpose financials with ASIC under the Corporations Act, or if they are a charity with over $250,000 in turnover and that are registered on the ACNC. So what are these changes and what needs to be disclosed? Basically, you need to, as a management, show more transparency and show where you are complying with accounting standards, criteria for recognition and measurement of a particular asset or liability, and you need to disclose where you are not compliant. So that's a big change. And you also need to disclose where you are or you're not compliant with consolidation and equity accounting, where you've got subsidiaries or associates. So some example wording of what you could say is that, these special purpose financials comply with all recognition and measurement standards as per Australian accounting standards, except for AASB 10, which is consolidation. So you don't need to quantify it, you just need to note what you are and what you're not complying with. So I've put here an example of the two most common areas that clients preparing special purpose financials do not comply with. Mainly employee benefits. So under accounting standards, you're required to discount non-service leave. Most clients don't do it where they're preparing special purpose financials. So you would just make note of that in the financials. The other one would be on grant revenue. So a lot of clients just defer revenue and don't actually take it up until the related expenses have occurred. So where you've got clients that meet those criteria, I would just suggest copying and pasting something like this template wording that I have here. Those are probably the two main ones. You could just Google other examples if you are wanting a bit more information around it. So the next standard that I want to talk to you about is the one where we get rid of special purpose financial statements. So basically from reporting periods beginning after 1 July 2021, so you're looking at year ending 30 June 2022, you can no longer, if you're a for-profit entity, prepare special purpose financials. Now, when I say that, it doesn't apply to all for-profit entities. So small proprietary entities are exempt. So that would probably be a lot of your clients being exempt. So it's for a large proprietary. However, point 2 is where you could have a few clients falling into this bracket. So if they are a cooperative that is for-profit, or an incorporated association, or a higher education provider, they are usually required to prepare financials that comply with Australian accounting standards. They would need to adopt this and they will no longer be able to prepare special purpose financials. The other area where you could be caught is if you're a trust or a different entity that has a constitution that requires compliance with Australian accounting standards. I would highly recommend having a look through your client base and seeing if you've got trusts or something similar that would have constitutions. If they have that statement in their constitution, get them to amend their constitution to take that out, because you really don't want to have to be preparing general purpose accounts unless you need to. The reason I'm talking about this now, because 2022 is a long way away, is because there is significant benefit to early adoption. So rather than wait for 30 June 2022, I would recommend having a look at your database at all clients that are impacted by this and getting them to do this for next year, 2021, because the transitional relief is that they do not need to restate comparatives, which is going to be so beneficial to companies. And it also means that where there are new disclosures, they don't have to have comparatives in there. So special purpose accounts obviously don't have all disclosures, but when you move to general purpose, there are going to be some new disclosures where you're going to have financial for current year and prior. If you take it up early, you don't need to show your prior year, you just show current year. However, this is the reason why I'm telling you this now. In order to take up and get these transitional relief, you have to, for this year, so 30 June 2020, have complied with all the recognition and measurement requirements. So I would definitely be looking at those companies, highlighting them and making them really well aware that they might want to change their Note 1 disclosure just to make sure they are complying it. And if there are things that they need to comply with, make sure that they do comply with them. Okay, so assume they meet the requirements and they have decided that at 30 June 2021, they are going to take up early adoption. What changes happen? Okay, so firstly, there is a new Tier 2 general purpose set of accounts that they will need to comply with. So there will no longer be the reduced disclosure regime that a lot of clients that prepare general purpose do. They have a new framework, which I'm going to be talking to in the next slide. So you would get them familiar with that template. If you're preparing the financials, you get yourself familiar with that. And you need to have additional note disclosure. You need to disclose that you're transitioning early. You would need to show the impact of equity of the changes. You will have to adjust your opening balances, but you don't need to adjust the comparatives. You would also need to have a description of what major adjustments would have been required to make the special purpose compliant. So, for example, taking up lease accounting, doing long service leave discounting. Those are probably the two most likely impact for general purpose. So those are just things to be mindful of. Now, what is this new Tier 2 general purpose account? So Tier 2 basically means that you're a reporting entity, but you don't have public accountability. So you don't issue shares or anything like that. You're not listed. If you are, then you have different sets of criteria that you need to meet. So this is for everyone that's a reporting entity, but not public accountability. I've put here on the next few slides, basically what's changed. It's an in-between of the special purpose. So it's a little bit more disclosure than a special purpose, but the good news is it's actually less disclosure than your current reduced disclosure requirements under general purpose accounts. So it's actually not a bad thing to move on to it early, even if you already take up general purpose accounts, because there's less disclosure that you need to comply with, which is great. So I've put on these slides basically what they are. You can feel free to have a read of that in your own time. I think the one area that I quite like as an auditor, the Note 1 on financial assets and liabilities. The current model accounts is about 3 to 4 pages on just this note, which I personally think is excessive, to say the least. So it's great that it takes out a lot of that, which is great. And it also reduces the amount of disclosure you need under lease accounting. So that's another good thing. So just get your head around that and be aware of it. So those slides show what's been taken out. This shows what's been added. As you can see, most of the stuff in there is not going to be applicable for 95% of your clients. Probably just the first point and the last point. So they haven't really taken anything additional into it. You're actually cutting out more than you're including. So that's really good, I think. I love the fact that you now have to disclose audit fees. That's great for me when it comes to quoting and tendering. So yay, I like that. And imputation credits that may potentially impact some of your clients.